February 28th, 2026, Tehran. At 2 in the morning local time, the first American bombs fall. By dawn, the supreme leader is dead. By midday, the Islamic Revolutionary Guard Corps has broadcast a single message to every vessel in the Persian Gulf, transmitted over maritime radio frequencies on a loop. No ship is permitted to pass the Strait of Hormuz. 50 oil tankers drop anchor immediately. Their captains are not waiting for a formal declaration. They are waiting for insurance coverage that no longer exists. The next day, March 1st, the number of anchored vessels reaches 100. Then 120, then more. Tanker traffic through the strait, which carried 22 supertankers per day, just 72 hours earlier, drops to 4 in a single 24-hour period. Then to near zero. By March 2nd, over 150 ships are sitting idle on either side of the waterway. 4 vessels have already been attacked. The world's largest container shipping companies, Maersk, Hapag-Lloyd, CMA, CGM, have suspended all Hormuz transits indefinitely. 20 million barrels of oil per day. Gone. When markets opened on Monday morning, the price reaction was immediate. WTI crude surged more than 7.5% in a single session. Brent crude up nearly 8%. That is not a routine geopolitical risk move. That is a global supply crisis arriving in real time. Everything you are about to hear comes from Bloomberg, Reuters, the tracking platform Kepler, and research notes from Goldman Sachs, Wood Mackenzie, Citigroup, and JP Morgan. This is not commentary. These are the trading desk memos and the ship tracking data that professional energy analysts were working with on the morning of March 2nd, 2026. Before we go deeper, subscribe right now if you have not already, and drop a comment telling me which of 3 scenarios you think plays out: quick resolution, partial blockade, or full closure. I read every comment. By the end of this video, you will understand exactly why 20% of the world's daily oil supply moves through a channel that is 33 kilometers wide at its narrowest. You will understand the single mechanism that makes OPEC almost completely powerless in this specific crisis. And it is not the mechanism most people assume. You will understand what happened in 1973, 1979, and 1990, and why what is happening now has the potential to be substantially worse than any of the 3. And you will see the 3 specific price scenarios that Goldman Sachs, Wood Mackenzie, Citigroup, and JP Morgan are currently running. Here is what you will walk away with. You will understand why a 33-kilometer strip of water between Iran and Oman is the single most important price-setting mechanism in the global economy. You will understand why the OPEC emergency meeting on March 1st, the one that made every headline, is essentially irrelevant to this specific crisis, and why that matters more than the headline suggests. You will understand why China, Japan, and South Korea are carrying the worst economic exposure from this event, and why that eventually reaches you. And you will see the exact price numbers the banks attach to each of the 3 scenarios playing out right now. This is not a story about oil prices going up. It is a story about a single geographic choke point that connects everything in the global economy and what happens when it stops working. Let me show you what happens when that choke point stops functioning. Because this has happened before. 3 times, and the pattern each time was precise. October 6th, 1973, the Sinai Peninsula. At 2 in the afternoon, 200,000 Egyptian troops cross the Suez Canal simultaneously. Syrian armor advances on the Golan Heights. The Yom Kippur War begins within the hour. 9 days later, OPEC ministers convene in Vienna. What they announce is not just a production cut. It is a production cut combined with a full oil embargo against any nation supporting Israel. The United States is the primary target. The valve turns. Before the embargo, crude oil trades at $2.90 per barrel. That number comes directly from the Federal Reserve's own historical records. By January 1974, the price is $11.65. Do the math. In under 4 months, the most important industrial commodity on Earth multiplied by 4. The United States enters recession. The stock market falls 45%. Inflation embeds at 11% and stays there for nearly a decade. It takes 2 Federal Reserve chairmen and interest rates of 20% to finally break it. And here is the number that most people miss. The embargo did not stop oil supply. It reduced it. The net supply disruption amounted to roughly 9% of global daily production. 9% caused a 4-year economic crisis, not 20. 9. Same pattern. Different decade. January 16, 1979, Mehrabad Airport, Tehran. After months of strikes, protests, and open revolt, Shah Mohammad Reza Pahlavi boards a private jet and leaves Iran forever. He tells his government he is taking a vacation. He never returns. The Islamic Republic consolidates power within weeks. Iranian production, which had run at 5 to 6 million barrels per day under the Shah, collapses dramatically. By early 1979, what was one of the world's largest oil exporters was shipping almost nothing. Oil prices double in under a year, then keep moving. Federal Reserve Chairman Paul Volcker responds with the most aggressive monetary tightening in American history, raising interest rates to 20%. 2 separate recessions follow. The economic consequences persist for 5 years. That is not a mild disruption. That is what a sustained supply shock does to a developed economy. August 2nd, 1990, Kuwait City. At 2 in the morning, Iraqi armored columns cross the border with almost no resistance. By 6 a.m., the operation is effectively complete. Kuwait is occupied. Kuwait produces roughly 2 million barrels per day. Iraq produces 3 million. Combined, nearly 8% of global supply disappears in a single night. Oil prices respond within hours, from roughly $20 per barrel in July to over $40 by October, a 100% increase in 3 months. The difference is that the shock is short. A US-led coalition removes Iraqi forces by February 1991. Production recovers within months. A brief recession, but nothing approaching the multi-year damage of the 1970s, because the disruption lasted fewer than 6 months. 3 shocks, 3 different sizes, 3 different durations, 3 different outcomes. The relationship is consistent. The larger the percentage of supply removed, and the longer that removal lasts, the deeper and longer the economic damage. So here is where we actually stand. 3 oil shocks in 50 years tell the same story. Remove 9% of global supply and you get a 4-year economic crisis. Remove nearly 8% for 6 months and you get a brief recession. What is at risk right now is 20% of global daily supply, more than twice the scale of 1973, with no end date in sight. Now you might be thinking, but Iran has not formally closed the strait. Iranian officials have stated they do not intend to shut it completely. That sounds less alarming, and technically it is accurate. Iran has not declared a formal blockade. But here is what that framing misses. The vessel tracking firm Kepler published their analysis on March 1st, 2026. Their conclusion: the strait is effectively closed for commercial shipping despite technically remaining open. The insurance withdrawal is doing the work that a physical blockade has not needed to do. The outcome for actual cargo flow is the same. Only 4 supertankers transited on March 1st, according to Vortexa tracking data, down from 22 the day before. The strait does not need to be formally closed. It needs to be too dangerous to insure. Right now, it is. Let me explain the geography, because the numbers only become real when you understand what this place actually is. The Strait of Hormuz sits between Iran to the north and Oman to the south. At its narrowest point, the number that matters 33 kilometers. That is roughly 21 miles. Inside that 33-kilometer channel, the actual shipping lanes that tankers use are only 3 kilometers wide in each direction. 6 kilometers of navigable corridor, total, for the movement of the world's energy. Through that corridor every single day, 20 million barrels of oil, 1/5 of everything the world consumes. Not a fraction worth rounding down. 1/5. 84% of it goes to Asia. China receives approximately 50% of its total oil imports through this channel. Japan is heavily dependent. South Korea runs its entire industrial base on energy that passes through a 6-kilometer shipping lane off the Iranian coast. There are bypass routes. The Abqaiq-Yanbu pipeline in Saudi Arabia and the Habshan-Fujairah pipeline in the UAE together provide some relief. Under current conditions, analysts estimate roughly 2.5 to 3 million barrels per day of effective bypass capacity, enough to help at the margins, but far short of covering the shortfall. 20 million minus 2.5 million still leaves 17.5 million barrels per day with nowhere to go. I want to pause here. The mechanics you just heard, the geography, the bypass capacity, the 6-kilometer shipping lane, this is the framework that most news coverage does not explain. If this analysis is useful to you, subscribe right now so you do not miss future analysis of this kind. And if you want this framework before the mainstream narrative forms, there is a newsletter for this channel. No noise, just the analysis. And on top of the crude oil, the Strait of Hormuz carries 20% of global liquefied natural gas. Qatar is the world's 2nd largest LNG exporter. All of its shipments transit through the strait. Now, I want to get to the one mechanism that makes this crisis structurally different from anything that came before it. On March 1st, 2026, OPEC Plus held an emergency meeting. The decision: add 206,000 barrels per day to global supply, beginning in April. 206,000 barrels against 20 million blocked. Read that again. That is barely 1% of the disrupted volume. But here's the sentence that Wood Mackenzie put in their March 2nd research note, and this sentence explains why OPEC's response is not just small, it is structurally irrelevant. They wrote, "The disruption creates a dual supply shock. Not only are current exports through the strait halted, but OPEC's additional volumes and ultimately most of OPEC's spare capacity are inaccessible while the waterway remains closed." Now some of you are thinking, wait, Saudi Arabia holds approximately 2.5 to 3 million barrels per day of spare production capacity. The UAE holds roughly 1 to 1.5 million. That is 4 million barrels at most that could theoretically enter the market within weeks. Why can that not rescue the situation? Because their oil also exports through Hormuz. Saudi Arabia's primary export terminals are on the eastern coast, feeding directly into tanker routes that pass through the strait. The Abqaiq-Yanbu pipeline bypasses the strait, but it runs near capacity and handles only a portion of total Saudi export volume. The UAE has the Fujairah pipeline specifically designed to route oil around Hormuz. 1.5 million barrels per day of total capacity, not 4 million. This is the unique and devastating mechanic of this specific crisis. The countries holding the most spare production capacity export through the same channel that is functionally closed. Saudi Arabia's safety net is trapped inside the Gulf. When people say OPEC can rescue the market, they are imagining a rescue team that can reach the scene. The rescue team is locked behind the same barrier. Let me put that in plain terms. Saudi Arabia and the UAE together hold at most 4 million barrels a day of spare capacity. But that oil exports through Hormuz too. The rescue and the emergency are both trapped behind the same locked door. If this analysis is giving you a framework you did not have an hour ago, hit the like button right now. It helps more people find this video and understand what is actually happening. Drop a comment telling me which scenario you think plays out. And share this with one person who is watching oil prices and wondering what the actual mechanism is. 3 scenarios. This is how the banks are currently pricing them. Scenario 1, quick resolution. Military de-escalation within 1 to 2 weeks. The IRGC stands down. Insurance coverage is restored. Tanker traffic resumes. Citigroup's base case places Brent crude at $80 to $90 per barrel in the near term. JP Morgan notes that Gulf producers hold roughly 25 days of storage and tanker buffer capacity, which provides a window if resolution comes quickly. Painful, but manageable for the global economy. Scenario 2, partial and extended blockade. The strait remains functionally closed for 3 to 4 weeks. Iranian harassment of vessels continues. Insurance remains suspended for commercial operators. JP Morgan has modeled this explicitly. A 3 to 4 week restriction through the strait could force Gulf production shut-ins and push Brent above $100 per barrel. Wood Mackenzie arrives at the same number above 100 if tanker flows are not quickly restored. Think about what that means. $100 oil means every economy in the world begins recalculating its next 12 months at the same time. Airlines repricing tickets, shipping companies raising freight rates, agricultural producers facing higher input costs before the harvest, all simultaneously. In 1979, oil doubling in price preceded 2 recessions. $100 per barrel is that same threshold entering the conversation. Scenario 3, full closure extending beyond a week. Goldman Sachs has already embedded an $18 per barrel war premium into current crude prices. That premium represents the market's current probability-weighted expectation of extended disruption. In a full closure scenario, Goldman analysts have indicated that Brent could reach $140 per barrel. Bernstein's extreme case puts the range at $120 to $150. $140. That is not a modern reference point. The last time oil was near those levels was 2008, the commodity supercycle that preceded the financial crisis. At $140 per barrel, the arithmetic on almost every economy in the world changes simultaneously. Step back for a second. Scenario 1 ends this within 2 weeks, with oil at $80 to $90, painful but survivable. Scenario 2 stretches it to a month, with oil above 100, the number that starts appearing in food prices and airline tickets within weeks. Scenario 3, full closure for more than a week, puts Goldman Sachs at $140. That is not a number the modern global economy has navigated without serious damage. Now, some of you might be thinking oil shocks have happened before. The world survived 1973, 79, 90. We adjusted, we adapted, economies eventually recovered. What makes this different? The starting point. In 1973, central banks had significant room to maneuver. Global debt levels were manageable. The Federal Reserve had both credibility and space to raise rates aggressively, which is precisely what Volcker did, and it still took 9 years. Today, most major central banks have already deployed significant monetary policy over the past several years. Inflation is not firmly at target across most developed economies. The financial system enters this shock with a different cushion than it had in 1973. That is not a prediction of collapse. That is the structural difference in starting conditions. So what have we actually established? 3 historical oil shocks confirm that supply disruptions of this type cause inflation and recession, and the severity tracks directly with the size and duration of the supply loss. What is at risk here is the largest potential disruption in the modern era, more than twice the scale of 1973. OPEC's safety net is partially trapped behind the same barrier, causing the problem. And the global economy enters this shock with less policy cushion than in 1973. 3 scenarios exist. 1 is manageable. 2 are not. I am not a financial advisor, and nothing in this video is personal financial advice. But here is what the data from 3 prior oil shocks suggests about the historical patterns that followed events of this type. In every major prolonged oil supply disruption, energy-producing companies significantly outperformed broader market indices in the 12 months that followed the shock. In 1973, oil company stocks significantly outperformed every other sector, while the broader index fell 45%. The mechanism is straightforward. The companies most directly tied to a commodity in short supply generate more revenue when its price rises. The same pattern held for domestic energy producers. Economies with meaningful domestic energy production showed more resilience than pure importers. The United States produces substantially more oil today than in 1973. That does not eliminate global price exposure because oil is priced globally, but it changes the structural vulnerability profile compared to economies like Japan or South Korea that import nearly all of their oil. And across all 3 disruptions, one factor determined the depth of damage: duration, not peak price. The 1990 shock peaked at a 100% price increase and caused a brief recession because it lasted months, not years. The 1979 shock caused a multi-year economic depression because the supply reduction became embedded. The honest assessment right now is that the duration question is unresolved. Goldman Sachs' $18 war premium reflects the market's current probability estimate, meaningful risk of extended disruption, but still tilted towards some form of resolution. Citigroup's $70 reversion scenario assumes de-escalation within 1 to 2 weeks. The market is saying it does not know. History says duration is everything. Let me bring this to where you actually live. The transmission mechanisms from an oil shock to your daily costs are historically consistent and well documented. Energy prices move first at the pump, in utility bills, immediately, then food. Oil is an input to agriculture, for the fertilizers that grow crops, for the trucks that move them, for the cold storage that preserves them, for the packaging that contains them. When oil moves from $70 to $140 per barrel, the cost of producing, moving, and delivering food moves at the same time. That is not an abstraction. That is your grocery bill. After food, manufactured goods. The factories in China, Japan, and South Korea, the countries receiving 84% of Hormuz oil, face rising energy costs. Their manufacturing costs rise. Their export prices rise. The products on store shelves follow within months. The smartphones, the electronics, the industrial components, the clothing, all of it priced in energy costs that are being recalculated right now. In 1973, this transmission took approximately 12 months to move fully through the economy. The shock was felt immediately at the pump, within 3 months in food, within 12 months across manufactured goods. The mechanism runs the same today. The variables are the scale of the disruption and how long it persists. The Strait of Hormuz has appeared in energy security reports for decades. Most of the time, it stays in footnotes and risk annexes. For the first week of March 2026, it is the center of the global economic conversation. 20% of the world's daily oil, 33 kilometers of water, a safety net OPEC's spare capacity that is partially trapped on the wrong side of the barrier. 3 scenarios with vastly different economic consequences, and a starting point that offers less cushion than any of the 3 prior shocks faced. History says the world has moved through events like this before, damaged, adjusted, and eventually recalibrated. The question that history cannot answer in advance is how much damage accumulates before recalibration begins. Now you have the framework to watch what develops with clear eyes. If this video gave you something you did not have before, subscribe to this channel. Share this with one person who is watching oil prices and wondering what the actual mechanism is. Hit the like button and leave a comment. I want to know which scenario you think plays out. I read every single one.